Hello and welcome to Earnings Echo. We put together the most important information about Oscar Health. Think about what it takes to turn a sinking ship completely around in just one single year. So today we are executing a rapid, strictly factual deep dive into their Q1 2026 earnings. We really want to figure out exactly how they pulled off this massive record-breaking quarter and whether the operational engine driving this turnaround is actually built to last for you, the listener.
Let's get right into the hard facts then. Total Q1 revenue hit $4.6 billion.
Wow.
Yeah, which is a 53% increase year over year. And net income reached a historic $679 million. I mean, that translates to $2.07 per diluted share. Management also reaffirmed all their full year 2026 guidance.
That profitability is just a staggering pivot. I mean, to put this in perspective for you, fiscal year 2025 ended with a $443 million net loss.
Right.
Flipping a nearly $500 million loss into a $679 million gain in a single quarter is just, well, it's whiplash-inducing. So what underlying margin developments actually forced these numbers?
Well, first off, membership skyrocketed 56% to 3.2 million.
Mm-hmm.
But the real driver here is the medical loss ratio, or MLR. This improved by 490 basis points, which simply means a drop of 4.9 percentage points, bringing it down to 70.5%.
Let's clarify that metric just so we're perfectly aligned. The MLR is essentially the percentage of premium dollars an insurer actually spends on medical claims.
Exactly.
So if it's 70.5%, Oscar is spending about 71 cents of every dollar on care, keeping the rest for administration and profit, meaning a lower MLR is a massive win for their bottom line. How did they drive it down so much?
Mainly through strict premium pricing and $68 million in favorable prior period development. Basically, they overestimated the cost of claims in previous quarters.
I see.
Yeah, and so those unused cash reserves are now flowing back onto the balance sheet as pure profit. Plus, at the same time, their SG&A, the administrative expenses, dropped to a record low of 15.2% of revenue.
The mechanics behind that cost drop are critical, right? They're aggressively integrating AI to handle this 56% membership surge without, a proportional increase in human headcount. They're automating back-end claims processing.
Right, and utilizing AI for customer service routing, too.
Exactly. But I do need to challenge the sustainability of these margins. I mean, Q1 inherently has lower medical claims because patients haven't hit their deductibles yet. How exactly do those suppressed Q1 claims impact their risk adjustment payouts? I'd imagine this creates a liability on the balance sheet.
It does, yeah. But management maintained a highly confident tone on the earnings call regarding this dynamic.
Yeah.
Because their members had lower than expected claims, Oscar now actually owes money into the federal risk adjustment pool.
Right.
Think of it as a system designed to balance out insurers who take on sicker, more expensive patients. That payable shot up to 24.5% of their premium revenue.
So they essentially have to pay a penalty for having a healthier patient pool this quarter.
Yeah. Exactly. However, management expects this liability to normalize closer to 20% as members hit their deductibles later in the year and actually start utilizing more medical care.
Makes sense.
Plus, early data from the Wakely report, which tracks the overall health and morbidity of the market, shows that the broader patient population is just healthier right now. It's acting as a macroeconomic tailwind.
Beyond the balance sheet, though, the call revealed a major strategic pivot, which is the launch of the Lucy Health Marketplace.
Oh yeah, the carrier-agnostic platform.
Right, exactly. Essentially, they want to capture employers who are dumping traditional group insurance and instead giving employees cash to buy individual plans, known as ICHRAs. This represents unregulated revenue.
Meaning Oscar isn't capped on profit margins like they are with standard health plans.
Yes, precisely. So looking at this new revenue stream and their massive quarter, what is the market actually pricing into Oscar's current $21.19 share price and $6.99 billion market cap?
To figure that out, we use a reverse discounted cash flow, or reverse DCF. So instead of guessing future cash flows to find today's price, we take today's stock price and work backward to see what growth rate the market expects.
Okay.
It's not an exact science, obviously, but it reveals investor expectations.
So in plain English, it tells us the hurdle rate Oscar needs to clear just to justify its current stock price for you guys listening.
Correct. Since historical earnings have been pretty unstable, we use a conservative $350 million net income base for fiscal year 2026.
Got it.
Plugging that in, the model shows an implied net income compound annual growth rate, or CAGR, of a positive 6.1%. This means the market basically expects earnings to roughly double to $631 million by fiscal year 2036.
A 6% growth rate is incredibly modest for a tech-forward company. I mean, that proves the market is pricing Oscar like a traditional, mature, stable insurer rather than some hyper-growth tech unicorn. So summarizing the core investment story here, Oscar is aggressively leveraging AI and technology to capture the shifting individual health economy.
Right, and the final echo for you to take away today is this. While Q1 showed massive scale and a shocking return to profitability, well, the market's pricing model reflects a strict demand for sustained, multi-year profitability before actually awarding Oscar a premium tech valuation.
The true test is whether they can manage the risk pool when patients start scheduling surgeries in the second half of the year. But here is a thought to mull over on your own. If Oscar's AI automation is the primary reason their administrative costs are plummeting, what happens when legacy behemoths like United Health deploy the exact same AI tools at 10 times the scale? Does Oscar's tech advantage completely evaporate? And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.